Let me tell you something that most people on Wall Street will never say out loud because it makes them look either stupid or dishonest, and neither one is good for business. The stock market, by almost every measure a reasonable person could use, should be in serious trouble right now. You have $40 trillion in government debt. You have tariffs slamming supply chains. You have a Federal Reserve that is visibly confused, cutting rates while inflation is still smoldering in the background. You have geopolitical fires burning on 3 continents simultaneously, and yet here we are. The S&P 500 keeps recovering. Every sell-off turns into a buying opportunity within days. People keep asking me, Peter, when does this thing finally crack? And my answer is the same every time. Stop asking when it cracks and start understanding why it hasn't. Because until you understand the machinery underneath this market, you are driving blind on a highway at night with no headlights. That is genuinely dangerous. So today I am going to show you the exact machinery. Pay attention. Before we go any further, I want to ask you something simple. If the information in this video is worth even $1,000 to your financial future, and I promise you it is worth considerably more than that, then the least you can do is hit the subscribe button right now. It costs you nothing. It takes 2 seconds, and every week you will get research, analysis, and planning with explanations that most people pay financial advisors thousands of dollars a year to receive, and half those advisors don't explain it this clearly anyway. Subscribe now. Do it before you forget. Then come back, because this next part is the part that actually matters. The first thing you need to understand is something traders call the Fed put. Now, I know that sounds like the kind of phrase somebody invented specifically to make you feel stupid for not knowing it. And honestly, they probably did, because Wall Street has always preferred that you feel confused. So let me strip the jargon away completely and tell you what it actually means. A put, in options language, is a form of insurance. If you own a put option on a stock, it means that no matter how far that stock falls, you have the right to sell it at a predetermined price. It puts a floor under your losses. The Fed is not a real financial instrument. You cannot buy it. It is a psychological expectation, a broadly shared belief across the entire investment community that if the stock market falls far enough and fast enough, the Federal Reserve will intervene. They will cut interest rates. They will inject money into the system. They will do whatever it takes to prevent a full economic collapse. And here is the crucial part. This expectation is not irrational. It is based on 15 years of evidence. The Fed did exactly that in 2008, when the financial system was genuinely on the edge of disintegration. They did it again in 2020, when the pandemic shut down the global economy and the Fed responded by printing trillions of dollars so fast it made your head spin. So every single time the market is cracked since 2008, the Federal Reserve has shown up with the fire hose. So investors have learned, rationally, based on repeated experience, that the Fed will not let a crash run unchecked. That expectation alone is enough to prevent panic selling from accelerating into a true freefall, because the moment stocks start dropping hard, smart money starts buying, anticipating the Fed rescue that history says is coming. Now here is where I need you to pay very close attention, because this is the part most YouTube channels skip. The Fed put has a kill switch, and that kill switch is inflation. The Fed can only rescue the market by cutting rates and printing money if inflation is under control, because cutting rates and printing money causes inflation. If inflation is already running hot, and right now, with oil prices elevated and supply chains still stressed, there is a real argument that it is, then the Fed is trapped. They cannot lower rates to rescue the stock market without making your grocery bill and your gas bill and your rent even worse. And a Fed that cannot act is not a backstop at all. It is just a central bank standing on the sidelines watching. That is the scenario you need to be watching for, because it is a scenario where the first pillar of this anti-crash system quietly disappears. The second force holding this market up is one that most individual investors completely overlook, and I think it is actually the most powerful force of all. When you step back and look at the sheer mechanical scale of it, I am talking about passive investing, index funds, and ETFs, and the extraordinary transformation they have caused in how money flows into the stock market. In 2010, passive investment vehicles accounted for roughly 19% of all the money in the market. Today, that number is approximately 60%. Think about what that shift actually means in practice. It means that tens of millions of ordinary Americans, school teachers, nurses, small business owners, factory workers, have money automatically deducted from every single paycheck and deposited directly into their 401 kilobits accounts, which then automatically purchase index funds, which automatically buy stocks. No human being is making a decision. No analyst is looking at a price-to-earnings ratio. No portfolio manager is asking whether this is a good time to buy. The system just buys. It buys when the market is at all-time highs. It buys in the middle of a correction when everyone on television is screaming that the world is ending. It goes on autopilot every 2 weeks without hesitation or emotion. The way I like to think about it is this. Imagine a bathtub with a faucet that never turns off. Money flows in constantly. When there is a sell-off, some water drains out the bottom. Yes, but the faucet is still running. The constant inflow cushions the drop and creates a persistent floor buying pressure that did not exist in anything like this scale before the index fund revolution. There is also a secondary mechanical effect that most people do not know about. The S&P 500 is not an equal-weighted index. The biggest companies take up the biggest share of it, and the top 7 stocks minus Nvidia, Microsoft, Apple, Amazon, Alphabet, Meta, Tesla now represent roughly 40% of the entire index. That means when your 401 kilobits automatically buys an S&P 500 index fund, 40 cents of every dollar you invest goes directly into those 7 companies. The biggest companies get the most money makes them bigger. Being bigger means they get even more money the next time. It is a self-reinforcing loop, which is why the largest stocks in this market seem almost immune to the kind of value-based selling that would have disciplined them in an earlier era. But I want to be very direct with you about something, because I have been in this business long enough to know that no mechanism lasts forever. The passive money machine has one vulnerability, and that vulnerability is employment. As long as people have jobs, they contribute to their 401ks, and the faucet runs. But if unemployment rises sharply, say from 4% to 7 or 8% because of a real recession, people do not just stop contributing, they start withdrawing. They liquidate retirement accounts to pay rent, to cover medical bills, to survive. The faucet slows down, and simultaneously somebody cracks open the drain, and there is a longer-term demographic pressure building quietly in the background. The baby boom generation is the largest cohort of investors in American history, and they are retiring in enormous numbers. They are shifting from the accumulation phase to the withdrawal phase. They are moving from putting money into the bathtub to taking it out. And that transition, played out over a decade at scale, is a headwind that this market has never actually faced before. I'm not predicting catastrophe. I am telling you to be aware of the machinery so you are not surprised when it shifts. The third force is one that makes some people uncomfortable to talk about, possibly because it implies that the stock market is less of a rational pricing mechanism than we all learned in school, and more of a giant automated feedback loop. I am talking about algorithmic trading, specifically the family of computer-driven funds that Wall Street typically calls CTAs, or commodity trading advisors. Though that name is somewhat misleading because many of them trade stocks and bonds as well, the core logic of these systems is extraordinarily simple. When prices go up, they buy more. When prices go down, they sell. There is no earnings analysis, there is no macroeconomic judgment, there is no view on whether a company deserves its valuation, there is only the trend, and the algorithm follows it. Now, your first instinct might be to say, well, if these computers sell when the market drops, that must make crashes worse. And you're right that it does make the initial drop sharper and faster. But here's what happens next. And this is the part that creates the V-shaped recoveries you keep seeing. When the market sells off hard, the algorithms sell, yes, but they can only sell what they own. Once they've exhausted their selling, which typically takes days, sometimes a couple of weeks, the selling pressure evaporates, the market stabilizes. It might even bounce slightly. And the moment the algorithms detect that stabilization, they interpret it as a new uptrend beginning, and they flip from selling to buying, aggressively, automatically. And because these systems tend to respond to similar signals, they often flip at roughly the same time, creating a sudden surge of mechanical buying pressure that sends the market sharply higher. One algorithm starts buying, another sees the buying and interprets it as an uptrend, so it buys more, which reinforces a signal for the next system, and suddenly you have a buying cascade that looks from the outside like a miraculous recovery, but is actually just a pile of computers doing what they are programmed to do. This is a large part of why every dip you have seen in recent years has looked like a buying opportunity in retrospect. It is not that the fundamental problems went away, it is that the mechanical buying exceeded the mechanical selling, and the market went up. Understanding this should change how you interpret short-term market movements, because a lot of what looks like collective human judgment is actually just code executing instructions. The fourth force is the most technically complex one, and I want to be honest with you up front. Most explanations of this topic are deliberately confusing, and I have never believed in deliberately confusing people. So I am going to explain it the way I explain everything, by starting with what actually happens and working backwards from there. In the options market, there's a category of participant called a market maker. Their business model is not to bet on whether stocks go up or down. Their business model is to be the middleman in every options transaction, buying from sellers and selling to buyers, pocketing the small difference in price on every trade, consistently at high volume. They do not care about direction, they care about volume and spread. But here's the thing, because they are constantly buying and selling options in large quantities on both sides of the market, they accumulate a portfolio of positions that has significant exposure to market moves. If the market moves sharply in one direction, their portfolio can lose a lot of money very quickly. So they hedge. They manage their exposure mathematically using a measure called delta, and they adjust their stock holdings continuously to keep themselves neutral, to make sure that a big market move in either direction does not wipe them out. And here is the counterintuitive part that matters for you. When the stock market drops, the mathematics of how options behave forces market makers to buy stocks, not because they want to, not because they think stocks are a bargain, because their automated hedging systems require it to maintain their neutral position. When the market drops, they buy. When the market rises sharply, they sell. This creates an automatic dampening effect on extreme moves in both directions, and it is one of the reasons that truly violent, sustained crashes are harder to produce than they used to be. The options market has effectively become a giant shock absorber embedded in the financial system, and most people watching the stock market every day have no idea it is even there. The reason I'm telling you this is not to impress you with technical knowledge. It is because understanding that these mechanical forces exist, the Fed put, the passive flows, the algorithms, the options market makers should fundamentally change how you interpret short-term market behavior. These are not signs that everything is fine. They are structural supports, and structural supports can fail. Knowing where they are is the first step to knowing when they are under stress. Now we arrive at the part of this conversation that I consider the most important, because explaining why the market has not crashed is only useful if it helps you understand what would actually cause it to crash. And I want to be direct with you. The conditions for a serious bear market are not as distant as the current price levels might suggest, and complacency about this is genuinely financially dangerous. The first thing that could break this system is the debt spiral reaching a tipping point in the bond market. Right now, the United States government is carrying approximately $40 trillion in debt, and that number is growing every single year with no credible plan to reverse it. As long as the interest rates on that debt remain relatively low, the government can service it. Investors accept it, and the stock market ignores it. But if bond investors, the people who buy U.S. government debt, start demanding higher yields to compensate for the risk of holding so much of it, something very significant happens. Money flows out of stocks and into bonds. Why would you take the risk of owning stocks when you can get 6 or 7% guarantee from the U.S. government? You would not. And as money rotates from stocks to bonds, stock prices fall. The higher bond yields go, the more attractive they become relative to stocks, and the more selling pressure the stock market faces. This is not a theoretical concern. The bond market is many times larger than the stock market. When bond investors get nervous, the consequences are not subtle. The second potential breakpoint is what I would describe as the inflation trap. If oil prices remain elevated, if Middle East tensions continue to disrupt energy markets, if tariffs push up the cost of imported goods, inflation can become a sustained problem rather than a temporary one. And sustained inflation puts the Federal Reserve in an impossible position. Their entire rescue playbook, cut rates, print money, inject liquidity, makes inflation worse. A Fed that cannot use its tools is not a backstop. It is a spectator. We have seen this movie before. In the 1970s, the Fed ultimately did defeat inflation, but the cost was brutal, back-to-back recessions that devastated ordinary Americans. The stock market lost enormous value in real terms over nearly a decade. That is not ancient history. That is a pattern that the current environment rhymes with in ways I find genuinely uncomfortable. The third risk is concentration. The top 7 stocks now represent 40% of the S&P 500. That means the index is, in a very real sense, a bet on those 7 companies continuing to justify their valuations. And their valuations are substantially based on the expectation that artificial intelligence will deliver enormous economic returns and will deliver them relatively soon. I have been investing long enough to remember the early internet era very clearly. The technology was real, the transformation was real, the long-term impact was everything the optimists predicted, and more. But the stock prices in 1999 were pricing in a future that was 10 to 15 years away, as though it were going to arrive Next Tuesday, when the market recalibrated to a more realistic timeline, the Nasdaq fell 80%. 80%. Now, I'm not saying AI is a bubble. In the same sense, the underlying economics are different. The corporate adoption is more concrete. But I am saying that the gap between perceived payoff and actual payoff is a gap that markets historically fill with a correction. And the larger the concentration in those stocks, the larger the potential impact on the overall index when that recalibration happens. The fourth risk is demographic. The baby boomer retirement wave I mentioned earlier. This is not a sudden shock. It is a slow structural change that builds over years. But it is directionally significant because it converts the largest generation of investors from net buyers to net sellers over the course of a decade. And the fifth risk is the one nobody can model, because by definition, nobody sees it coming. The black swan and the 2008 crisis was in large part a black swan, not in the sense that the risks were invisible, but in the sense that the specific chain of events that triggered the collapse was not predicted even by people who were worried about housing. Every major crisis has an element of this. The specific trigger is always a surprise. Even when the underlying vulnerability was visible in advance, what I'm telling you is that the vulnerabilities are visible right now. The debt is real. The inflation risk is real. The concentration risk is real. The demographic shift is real. A black swan does not create these vulnerabilities. It simply finds them. So your job is not to predict the specific event. Your job is to make sure your portfolio is not catastrophically exposed to any of the existing vulnerabilities, so that when the specific event arrives, whatever it turns out to be, you survive it and you are positioned to benefit from the recovery that follows. Here's what I want to leave you with, and I want you to actually hear this rather than letting it wash over you the way most people let the end of a financial video wash over them. You now understand something that the majority of investors, including many professional investors, do not fully understand. You understand that this market is being supported by four distinct mechanical forces: the expectation of Fed intervention, the constant inflow of passive investment money, the behavior of algorithmic trading systems, and the hedging mechanics of options market makers. You understand that these forces are real, they are powerful, and they have produced the V-shaped recoveries you have been watching for 15 years. And you understand that each of these forces has a specific vulnerability: inflation, unemployment, AI, disappointment, demographic shifts, and debt that could disable it. So what do you do with this knowledge? You stay invested, because the system is still functioning and fighting the tape is expensive, but you stay invested. Intelligently, you watch inflation, you watch the Federal Reserve's actual policy decisions, not just their statements. You watch the bond market, specifically 10-year Treasury yields, because when those yields rise sharply, the warning light is blinking, and you make sure that your portfolio has some exposure to assets that perform well when the system under stress, hard assets, commodities, sectors that benefit from the specific risks that are building right now, the investors who get hurt in the next serious bear market, and there will be one. There always will be the ones who assume that because nothing has broken for 15 years, nothing can break. Do not be that investor. Now go and do something with what you just learned. Share this with someone who needs to hear it.